Everything you've been told about stock buybacks is wrong. Most people think they're just a neat way for companies to reward shareholders. But the truth, stock buybacks are one of the most powerful engines of inequality in America. They make CEO focus on short-term stock prices instead of building long-term businesses. And here's the wildest part. They were basically illegal until the 1980s. In this video, I'll take you through the history of buybacks, why they exploded, how they've reshaped corporate America, and why they can quietly turn healthy companies into what I call zombie companies. Businesses that look alive but are rotting underneath. And by the end, you know why this debate matters to your money, your job, and the future of our economy. Let's start with a little history. Before 1982, stock buybacks were treated with suspicion. Why? Because when companies buy its own stocks, it looks a lot like price manipulation. Imagine if you could bid up your own house price before selling it. People would call that shady. For decades, companies avoided buybacks because they didn't want to face lawsuits or regulatory penalties. Then came the SEC's Rule 10b-18 in 1982. This rule created a safe harbor. As long as companies followed a few conditions on timing, volume, and price, they'd be protected. It didn't explicitly legalize buybacks, but it gave corporate America the green light to use them without fear. And what happened? Well, the floodgates opened. From 1980s onward, buybacks went from rare to routine. In the last decade alone, the S&P 500 companies have spent trillions on buybacks. To put it in perspective, in some years, they spent more buying their own shares than on research, development, or even paying dividends. Now, why do companies love buybacks so much? Here's the financial sleight of hand. Earnings per share, or EPS, is the most watched numbers on Wall Street. Analysts track it, algorithm trade it, and executives get bonuses tied to it. When a company buys back stocks, it reduces the number of shares outstanding. That makes EPS go up, even if profits stay the same. It's like slicing the same pizza into fewer pieces and bragging that each slice is bigger. Nothing's changed about the pizza, but it looks more satisfying, and that perception drives investors to bid up the stock price. The problem? It's artificial. Nothing real was created, no new product, no new technology, no higher wages for employees, just financial engineering. This is where buybacks really become dangerous. CEO pay is heavily tied to its stock price and EPS growth. Stock awards, bonuses, and performance targets all depend on those numbers. Research show that when a CEO stock options or equity awards are about to vest, buybacks spike. Why? Because it's the fastest way to inflate the stock and maximize their payday. For a new CEO, the pressure is even worse. Boards today are much quicker to fire executive if the stock doesn't move within the first couple of years. That's a huge incentive to pull the buyback lever instead of making long-term investments. Think about what that means. Instead of focusing on innovation, building products, or investing in employees, CEO chase a short-term pop in the stock price. It's the corporate equivalent of drinking an energy shot instead of eating a meal. You feel a quick rush, but in the long run, you're weaker. And that's how companies start drifting towards zombie status. They're alive, their stock price looks good, but inside, they're starving for real investments. So what's the trade-off? Every dollar spent on buybacks is a dollar not spent elsewhere. And let's be clear, we're talking about hundreds of billion dollars every single year. That's money that could have gone into research and development, creating new technologies, or expanding into new markets. It could have gone into paying workers more or strengthening supply chains. Instead, it's used to manipulate a number on a quarterly report. That's the hidden cost. Buybacks don't just move money around. They shape how companies behave. They encourage cutting corners, underinvesting in the future, and prioritizing optics over outcomes. And here's where it ties into society. Who really benefits from buybacks? It's not the average worker. In the US, the wealthiest 10% of households own almost 90% of the stock market. That means when companies spend billions on buybacks, the vast majority of gains flow upward to those already wealthy. Meanwhile, workers, the people who actually make the products and run the businesses, rarely see any benefits. Their wages stagnate, their benefits shrink, but the shareholders at the top cashes in. That's why buybacks aren't just a financial tactic, they're a driver of inequality. They widen the gap between the investor class and the working class. Now, to be fair, there's another side. Warren Buffett has famously defended buybacks, but with a condition. He says buybacks make sense if a company's stock is undervalued. In that case, buying back shares is like buying dollar bills for just 80 cents. It increases value for the remaining shareholders. And in theory, that's fine. The problem is most companies don't actually wait for undervaluation. They launch buybacks at market highs when executives are eager to show strength or when their bonuses are on the line. That's not a smart investing. That's financial manipulation with shareholder money. So while there's a theoretical defense of buybacks, in practice, the evidence show they're mostly used for short-term optics, not long-term strategy. And that brings us to this decade. Lawmakers are starting to push back. In 2023, the US introduced a 1% tax on net buybacks. Some politicians are calling to raise it even higher, arguing that companies should be encouraged to reinvest in workers, innovations, instead of juicing the stock market. If you're investing, don't just celebrate a buyback headline. Ask if this company repurchasing because it's undervalued and healthy, or because it's desperate to boost numbers. That difference is critical if you want to avoid zombies in your portfolio. So here's my challenge to you. Should buybacks be capped, taxed harder, or even banned again? Or should companies be free to do whatever they want with their cash? Drop your thoughts in the comments below, because this debate is shaping the future of our economy. Thanks for watching, and I'll see you in the next one.